Good afternoon, distinguished colleagues. It's my pleasure to welcome you. On behalf of the chairman of the MBA Institute of Continuing Legal Education, Mr. Tobena Erujekwe, it's indeed our pleasure to be collaborating with the Capital Market Solicitors Association to host this training. This is day 3. It's been quite insightful, very useful, and the feedback has been very positive. So for today, I'll yield very quickly to the chairman of the CMSA to do the introduction of our speakers. Yes, indeed, our participants are waiting and all excited to be a part of this training. And all I can say is thank you for the collaboration, and I wish you all a very interesting time this afternoon. Thank you.
Good afternoon, everyone, and welcome to day 3 of our capital market stream. As always, today promises to be very exciting. We have Mrs. Zelda Akindele, who will be our facilitator for today. And the topic is the overview of the equities capital markets. Zelda is a partner with Templars Finance Practice Group. She holds a Master's of Laws in Banking and Finance from the London School of Economics, and she was admitted to practice in Nigeria and in England and Wales. She's also a co-author of the Nigerian chapter of the International Banking Regulation Review for 2010 and 2011, published by the Law Business Research UK, and sits on the FMDQ Exchange Debt Capital Market Subcommittee on Regulation Consolidation. Round of applause for Facilitator Zelda. Over to you, please.
Good afternoon, everyone, and good afternoon, Vincent. Thank you very much for that warm and I must say very kind introduction. So good afternoon to all our participants. I've been watching the chat box, and I'm really excited to see that we have so many members from across the country. I've clocked participants from Kaduna, from Abuja, those in Lagos, Port Harcourt, all over the country, and it's really exciting for us. We're very happy that you could participate. Thank you for joining the session. Hopefully it's going to be an interesting one. I'm just going to share my screen now so that we can get, so I can put my slides up. Okay, here we go. Let's put it in slide mode. Okay, great. So I trust that everyone can see and we're good.
Yes, we can.
Great, thank you, Vincent. So what we're going to be doing today is we're going to be talking about the equity capital markets. I appreciate that there was a session yesterday on debt capital markets. And because we wanted to open up the session to as many as possible and keep it as wide as possible, this is not targeted at any particular years of experience or years at the bar. I say this because some of what I will be talking about today may be very familiar to you, and some of what I may be talking about may be new to you. But the idea is that I can share the framework around the equity capital markets in Nigeria. I can discuss the role that we as solicitors have in this market, some of the legal issues, and particularly the documentation as well that come up. Hopefully you'll all find it very interesting and informative. And there will, of course, be time for Q&A at the end. I'd be happy to take as many questions as I can. We have a Q&A box. If we could kindly ask that you please, I'm just pointing to it up there now. If you please type your questions in as we go on, and that way when we get to the Q&A section of today's session, it will be easy for me to just pick up your questions from there. Great, so without much further ado, let's start. Sorry, so this is just contents, essentially, what we'll be going through today. In terms of the general overview, we'll talk about equities, primary market, secondary market, the laws, the regulations, the regulators. I'll take you through those key market players, and then what we call the equity capital markets infrastructure, and also differentiate between public equity issuance and private equity issuance. And then finally, we'll go through the legal documentation and some of those legal issues that we need to bear in mind as solicitors and lawyers advising in that space. Great. So I probably don't need to spend too much time explaining this, but again, for the benefit of those who may not be too familiar, because sometimes we know things, but we don't necessarily know the different, nomenclature or names that are used. So equities, we're all familiar with. Equity in a company, in a business concern, sometimes called stocks, at law referred to as shares, but in the market, from the securities perspective, always called equities, all right? So they represent the ownership in the issuer, an issuer we'll talk about a little bit, but essentially the company, right? And it represents your beneficial ownership, that you're a holder in that company. So what that means is that you have a claim on the residual profits of that company, the issuer. There's also limited liability, but with companies, it extends to the amount unpaid on the equities held, right? Now, what your equity in a company, i.e. your shares or your stocks in that company do is that aside from giving you a claim on the residual profits, most importantly, they afford the right to attend and vote at every meeting of that company, right? And that's where the real ownership and to some extent control come in. And it's important that we bear this in mind because we'll be talking about public companies today. So it's important to understand how that ownership works in the context of a public company. Okay, so the primary market and the secondary markets, right? And I'm sure, again, that many of you will be familiar with these, but maybe not necessarily with the idea that there is a primary market and a secondary market for equities. And this is global. It is not specific to Nigeria. So the primary market is where we talk about new issuances, fresh issuances. And what does that mean? It means the company itself is issuing equities, so issuing shares to the public, right? And two things happen in the primary market scenario. One is that the company itself is essentially selling ownership in itself, right? So it issues shares, members of the public pay, and the payment, the proceeds from those shares, from that issuance, goes directly to the issuer, to the company, right? Now, what that means is that the primary market provides access to capital. A company can sell securities in itself and gain capital, right? So the primary market is access to capital. Now, the secondary market, interestingly enough, does not actually at all involve the company itself. The secondary market then becomes between holders of equities in the company. The company has already issued the shares, already issued the equities. So what now happens is that holders of those equities sell amongst themselves. That's the secondary market. The proceeds, any money that is made from the sale, goes to the holder of those securities, the holder of the equities, commonly referred to as the shareholders. So in the secondary market, the shareholders will get the proceeds of trade. Now, the secondary market, two arenas, either a recognized and registered exchange or it's over the counter. So when I say over the counter, what do I mean? And this may have come up when you talked about debt capital markets yesterday, because OTC also exists for debt issuances as well. So over the counter simply means it's not done via any formal exchange, right? Over the counter means there is a dealer-broker network or relationship, and it's done one-on-one, party to party. So for instance, if I have shares in X public company and I want to sell them to Mr. A, I can do it over the counter via my broker and their broker, right? So you have OTC as well. So that's generally the primary and the secondary markets for equity capital markets. Now, an overview of the laws, regulations, and regulators, which again, I expect that many of us today know this and understand it, but it's worth just going through so that we have that overview for today's discussions. Now, the primary legislation that governs and regulates the equities capital markets is our Investments and Securities Act 2007, as amended. It has been amended previously, and I understand that there is a bill in the works for a new Investments and Securities Act. I know that some of it has been shared with some members in the market for commentary. We're not sure quite when that will come into force, but excuse me, but it is on the horizon, right? Now, alongside, hand in hand with the ISA, are the Consolidated Rules and Regulations of the Securities and Exchange Commission 2013. And these rules are amended and supplemented from time to time. And if you are a solicitor, a lawyer practicing in the capital markets, in the equity capital markets, you sincerely need to keep an eye on the rules and regulations of the SEC. We popularly just call them the SEC rules, right? Because different rules get amended and updated, some even repealed, excuse me, on a regular basis. And so it behooves you to ensure that you're completely up to date on the latest rules. The SEC website, they're very good about publishing their rules when they issue them. So please do keep refreshed with that. Now, another law that is very relevant here is our CAMA, right? And apologies, that says CAMA 2004, but the eagle-eyed amongst you would already have spotted that that's a typo. And obviously it should say CAMA 2020, which is, I'm still referring to as new CAMA because I was too used to the 2004 one. But CAMA obviously governs all of the activities of companies in Nigeria. And when we talk about equities and we talk about companies being the issuers, obviously what companies can do, how they can act, particularly with their securities, that is their equities, the shares that they issue, whom they issue them to, and how they issue them is all governed by the CAMA. So that's where that comes in, right? Now, secondary to all this legislation are the rules and regulations of the various exchanges. Now, primarily is Nigeria Exchange Limited, the NGX, and we're going to talk a little bit more about the NGX, in this session. But it's important to understand that the NGX and NASD OTC, and also FMDQ, but we'll talk about that later as well, have their own rules and regulations for participating and utilizing their exchanges. So this gives you an overview of the legal and regulatory framework around the equities capital markets, right? So we have an idea of the framework, who's enforcing it, who's regulating it. If you remember nothing today, remember that when it comes to capital markets, SEC is king. When it comes to equity capital market, SEC remains king, okay? The Securities and Exchange Commission has overall purview of all of the capital markets, length and breadth of it, including the equities, which means it also is the regulator of the NGX, okay? So if you remember no other regulator, if you abide with no other rules and regulations, SEC cannot be ignored on an equities capital markets transaction. Okay, so you have to keep abreast of all of their timelines, all of their regulations, all of their filings. And if this is an area that you intend to practice in or you've begun practicing in, I would advise you to familiarize yourself with some of the SEC officers. Some of them have been there for more than 10 years. They are very, very familiar with the market players, all of the transactions, and they can be very helpful. So, for example, I myself have a number of relationships with the SEC officers, so that when issues and matters come up on transactions, you can actually make those informal calls and say, oh, this has come up. What's SEC approach to this? What's the rules say? How do we interpret this rule? Because you will deal with SEC on an almost daily basis if you're practicing in capital markets, including on the equity side. I can't say enough about SEC. Like I said, SEC is king in this space, okay? Now, with the other regulators, we have like NGX Regulation Limited. And like I mentioned, we're going to talk about the NGX a little bit later in today's session because there have been some changes in the way that the Nigerian exchange is structured and how it operates. But at this stage, suffice to say that the NGX and NASD are what we call SROs, self-regulatory organizations. And, excuse me, What that means is that they are able to create their own rules and frameworks and guidelines for their participants and their members. So if you want to use the exchange, you have to abide by their rules. However, each of them are registered with SEC in accordance with the ISA, which means that SEC still maintains regulatory purview over them. But it is important to understand that those rules of the exchange and NASD still have to be abided with. So, key market players, who is who in equities capital markets? Well, the most important player, of course, is the issuer, right? And that's your company, your body corporate that is actually offering its equity securities to the public. Without the issuer, there is no transaction, there is no capital markets activity whatsoever. Okay. Now, close to the issuer, you will always find the issuing houses. The issuing houses advise the issuer on the structure of their offer. They carry out necessary filings. Actually, I should minimize this. There we go. They carry out the necessary filings at the SEC and any other exchanges, right? Especially if they're going to be listed. So again, some of you will be familiar with them. Some of the very, very active and prominent issuing houses will include the likes of Chapel Hill, Stanbic IBTC Capital, United Capital. There's so many, too many to name, right? But you will see them frequently on transactions. Then you have
okay, okay, fine. Your screen is back up. It was dark for a minute. Sorry about that.
Is it back up?
Yes, it is.
Excellent. Okay. And so then you have the stockbrokers and the dealers, right? Now, they are necessary because they essentially facilitate transactions on the exchange. And remember that we're talking about equities, shares, right? So also referred to as stock. So these are the guys who you'll hear people talk about my stockbroker, my stockbroking account. You open an account with a stockbroker and say you want to buy shares in flour mills, right? Your stockbroker does that for you on the exchange. And the advantage of the exchange is that you don't need to know anybody who wants to sell shares in the company you want to buy. Your stockbroker goes out and finds shares for sale on the day you want to buy them and does that for you. So you have those stockbrokers and dealers. And in the context of equity capital market transactions, they're important because they sponsor the application of the issuer to the NGX, right? And they are then responsible for arranging and supervising the activity. So on the day of listing of the equities and the offer, whether it is an initial public offer or just an offer for sale, and we'll talk about those later today, they are responsible for all of those activities. So your stockbrokers are actually relevant in both the primary markets and in the secondary market as well. Your issuing houses, you will really typically only see in the primary market, same as your issuer. The registrars are both in the primary and in the secondary market because, like the name suggests, they keep a register of all of the holders of equities, right, during an offer and from time to time. So it's that record that is the ultimate record of who actually holds equity securities in this issuer. Then you come to what I would say are the most important players, and that's us, the solicitors. So what do? We give legal advice on the entire process in an offering of equity securities, and we prepare legal documentation. And you'll notice that what I have there are solicitors in plural. That's not because I'm talking about all of the solicitors. It's because on these transactions, you will often find more than one set of solicitors. And we'll talk about our role a little bit later in the session. Then you have a receiving bank, right? And receiving bank is more in the primary market for equity capital markets. And that is where there has been an offer for sale, either an initial public offer or an offer for sale of equities. The proceeds from the public, because remember, these are offers to the public. So the proceeds from those sales will need to be held or will need to be collected, so to speak, by one bank. Often we have multiple banks, right? And they're all held there until the offer closes, and then it's disbursed to the issuer. In some instances, you will have subscribers or applicants who either have tried to buy shares, but the offer is oversubscribed and there's no availability for them, or you will have those who have paid more than they should. In that instance, those monies are not actually given to the company, the issuer. The receiving bank, it is part of their role to ascertain who should not have paid because they're not having any allotment of shares and who has overpaid, and then they will return those monies. So in a nutshell, these are the key players, right? So now let's talk a little bit in detail about the role of solicitors, because at the end of the day, we've achieved nothing today if we don't walk away understanding what we as lawyers in the equity capital markets are supposed to be doing. So what do? We prepare the issuer for, let me slow down. There are two roles in equity capital markets for lawyers, right? The first role are solicitors to the issuer, and the second role are solicitors to the offer. Okay. Now, as you guys will all be familiar, on most commercial transactions, you have two sets of lawyers anyway, one on each side. Now, with an equity offering, it's a little bit irregular in the sense that on one side, you have the company that is offering its securities, but on the other side, rather than having one individual or one company or one group of entities that are your counterparty, you have the public. Now, you cannot have a situation where every member of the public hires their own solicitors in order to go through the legal details of the offer. So rather, what happens is that the issuing houses, in conjunction with the issuer, appoint a solicitor, or a firm of solicitors rather, who stand in for the public, right? They're there to represent the interests of the public. And that's why they're known as the solicitors to the offer. Okay. Now, even though they're appointed by the issuer and issuing houses, the role is very, very clear. One set of solicitors acts for the issuing company. The other set is there to represent the interests of the investor public. Okay, so let's talk about the solicitors to the issuer first. And I can tell you that based on experience, when you are talking about a first-time offering in the capital markets of equities, so an initial public offer, for example, the bulk of the work will be with the solicitors to the issuer, right? Because there's a lot of preparation that goes in to preparing a company to offer its shares to the public to invest in. So one of the first things that you will begin to do is preparing the issuer for due diligence, right? Because what will happen is that the solicitors to the offer, remember, solicitors to the offer are there to represent the investor side, will need to do due diligence because nobody acquires shares in a company or invests in a company without doing some due diligence, no matter how minimal. So you'll even want to understand when was the company incorporated, who are the founding shareholders, who have been the directors, what exactly have they been doing, do they have any liabilities, do they have any assets, what's their current value, so things like that. Now, one thing to bear in mind as solicitors to the issuer is that when a company is making a public offer of its shares, it is really, in every sense of the word, becoming a public company. What that means is that you need to prepare your client, that is the issuer, for almost everything to become public knowledge, right? And so there has to be a management of information. There has to be a preparedness around corporate governance, because sometimes you'll find that with private companies, they are extremely profitable, very well managed, but they don't necessarily meet the same corporate governance standards as would be expected of a public company, for example. That is not to say that they are poorly run or that they're bad companies. They've just been private companies doing things their way. But in order to ask the public to invest, there are certain standards that have to be instituted, all right? And so these are some of the things that solicitors to the issuer will be preparing. Now, one of the very technical things that will typically have to be done is that when many companies decide that they want to actually make an offer to the public and become a listed entity, they will need to convert from being a limited company to being a public company, right? Because very, very often, I would say 8 times out of 10, that decision to go public and list equities in the capital markets is made by companies that are private. Now, the process for conversion of a company from being a private limited company to a public limited company is well set out in CAMA. And that's a process that you have to follow the CAMA process and work with the CAC to achieve. But it is the first step. And as we'll see later on, the Investment and Securities Act, the ISA, right, and the SEC rules and SEC very clearly states that only a public company may offer its shares to the public. So only a public company. And that is the reason why we need to convert. Okay. Then the other thing that the solicitors will do is that they will assist in ensuring that the prospectus or other offering document contains accurate information about the company. So you can see from what I'm saying so far that when you act as solicitors to the issuer, you really need to get to know the company very well. And quite often at the start of these sorts of transactions, when you are acting in this role, you have to spend a lot of time with the company, spend a lot of time with management and some of the key officers, getting to know them, understanding a lot of their detail and their processes, right? Solicitors to the issuer will also prepare corporate approvals and ensure that consent documents are duly executed. They'll negotiate some of the other documents that we will discuss on behalf of the issuer. And then there are certain meetings that you're required to participate in. For example, the SEC requires that on all capital markets transactions, you have an all parties meeting to kick off and an all parties meeting to complete. This is in addition to several other meetings as well that you will have, but those two are SEC mandated meetings, and you would have to attend all of them as solicitors to the issuer. Solicitors to the offer. Now, recall what I said. This is the role essentially of solicitors to the investor. It's just that you're not being appointed by the public. You're being appointed on behalf of the investing public. And so you're known as solicitors to the offer itself. So what you have to do in that role is you have to understand that you are there to represent the investor and all of your work is done from the perspective of the investor. So you're conducting due diligence with the frame of mind that your client is seeking to invest in this company. So what do I need to discover? What do I need to understand? Well, primarily to be things like, are the company's books in order? What are the liabilities they have out there? And in that regard, what are their claims and litigations, both for and against the company, right? So when we talk about their liabilities, for example, it could be, are they owing huge amounts to certain banks? Do they have unpaid debts from a decade ago? Those are the kind of things that matter. When we look at claims and litigation, it will be things like, well, does this company have potential litigation that is so significant against it that should it lose this matter and a judgment is made against the company, then it will erode all of the value? Because naturally, if such a claim exists, that is what we would call life-threatening to the business of the company, then that is obviously of concern to the investor and should be flagged by the solicitors to the offer prior to the offer going to the public. And just so that you are aware, that is one of the things that SEC actually also looks at. So they'll be checking whether the solicitors to the offer have checked the pending claims and litigation, to the point where you are actually required to issue a legal opinion on the claims and litigation. Now, from a practical perspective, we appreciate that given timelines, on some of these transactions, it is not always possible or practicable, or even from a cost-effective perspective possible, to go through every single litigation or arbitration or dispute matter or claim for or against a company, right? So typically what would happen in the first instance is that the solicitors to the offer would request a schedule from the company. That schedule will give the name and the dates and the relevant courts of all of the claims and litigation. It would give a very brief summary of the facts at issue and the claim that is made. and it would note both the monetary claim and any other, prayers. So for example, if an injunction has been sought, right, that will also need to be listed as well. As solicitors to the offer, when you receive that schedule of claims and litigation, it is then your job to review it in detail, identify, right, those matters that we would consider material. By material, I mean, I mean significant. And where there are matters which are significant, either because of the nature of the claim or because of the monetary value, that is when you will then ask for further information on those particular matters. I should mention that it's not uncommon when you are dealing with a very active company that has been around for many years, that the schedule of claims and litigation is so extensive, not because they're a bad company, but because as lawyers, we know litigation happens, especially when you're a trading entity. So it's not uncommon that between the issuing house and the solicitors to the offer and solicitors to the issuer and the issuer itself, we will set a threshold for claims and litigation. So for example, that threshold may say, we're not going to look at anything over a claim for 100 million naira or 50 million naira. That threshold will really depend on two things. It will depend on the nature of business and financial strength of the company. So if you're talking about a company that is worth upwards of 10 billion naira, then 1 million naira claim is really immaterial, right? And so that has to be, the threshold needs to be way above that. And then the other would be the actual quantity, the number of claims and litigation you have. Like I said, if it's a company that, for example, has 30, 40 matters in dispute, pending and before the court, then you might want to, shorten that list. But if it's a company that has only 10 matters, then you ask to see everything, okay? The other thing that is an important part of the due diligence for solicitors to the offer are material contracts. And what do we mean when we say material contracts? So these will be any contracts that your issuer is party to, which are material to its business. So for example, supply contracts, if it is a manufacturing business, right? Those supply contracts that are integral to its business, meaning that if something happens to that supply contract, if it is terminated prematurely, or if the supplier is not able to continue supplying, then it is a threat to the business. That is a material contract. On the flip side, if the company provides services, right, then contracts with those it provides services to are critical. So let's say the company has 4 government contracts, which are really the basis of its value, right? You will need to review them to see if anything could go wrong or they could be terminated early, etc., because those are all risks to the business. And remember, as I've said, solicitors to the offer stand in the position of the investor. So in performing your role as a solicitor to the offer, a big part of that role is flagging any risk to the business, okay? In addition to that, you'll also be responsible for ensuring that all the regulatory consents and approvals are obtained. Now, based on what we've discussed, you may think that that is solely in relation to the Securities and Exchange Commission, SEC. Well, you're right. That's a big part of the regulatory approval process. However, for issuers that are in what we call regulated sectors, they will typically also require a no objection from their sector regulator. The most common example will be with banks and other financial institutions. They are obviously regulated by CBN, the Central Bank of Nigeria. And typically, if they're going to list, they're going to go public, right? They will need a no objection. Now, why is this relevant? Because offering shares to the public, that's not part of what I'm doing. And my sector regulator is there to regulate my business in that sector, right? Well, actually, what you will find is that when equities, securities are offered to the public, very often it results in what we as lawyers refer to as a change of control of the company. That means that the shareholders who are in control can change. Or let me say, or, not only will you get a change of control, it is also possible that you will have new shareholders who have a significant shareholding, right? Significant shareholding tends to be, in most sectors, 5% and above. Now, it may not be so significant that it requires a approval process, but at the bare minimum, it will also require notification. So some of these regulated sectors will be, like we've said, banks with CBN, insurance companies with NICOM, pension companies, PENCOM, etc. So as solicitors to the offer, again, you need to ensure that everything that needs to be done has been done properly and accordance with the appropriate timelines, okay? The next thing that you will have to do is, okay, so we're getting in shape, everything seems good, the company is all right, and we can go ahead to offer the shares. So how do we go about it? We're going to get regulatory approvals, but also we have to comply with the rules for listing, okay? So typically, this will be the NGX rules. And like I said, we'll talk about them a little bit further down the line. But that compliance with the NGX rules is critical, and it's a very important part of the role of solicitors to the offer. You will also in this role be required to prepare and negotiate the offer documents, which we'll talk about, but these include your prospectus, for example. And then you'll be advising the issuing houses on regulatory compliance, okay? Now, in everything that I've said, one thing I want you to remember in terms of the role of solicitors in equity capital markets, right, is that the solicitors to the issuer are there for the company. They're there for the issuer, right? They want to help it be in shape, and they also want to protect it. The solicitors to the offer stand there to protect and act for the investing public. And so in many regards, the solicitors to the offer are a check on the transaction, a check on the offer. Have they done everything they're supposed to do? Is the company in the good health it needs to be in? Have they complied with all the regs and gotten all their approvals? Are the documents in shape? Is the issuing house aware that they needed to do this, that? That is really at the crux of it, the role of the solicitors to the offer. And just like with the solicitors to the issuer, you will also be required to attend all of the all-party meetings. As I mentioned, SEC mandates a kickoff meeting and a completion meeting at the minimum between all parties, and you also have to attend that as well. In between, there will, of course, be several other meetings. And typically, in practice, what tends to happen on these transactions is that you will either have a standing weekly meeting or bi-weekly meeting as the offer progresses. Way back in the day when I started, these used to be physical meetings, but by and large now they're completely virtual, which makes it a lot easier. But like I said, they are mandated. Okay, so let's move on to the equity capital markets infrastructure. And I'm sure that when you saw this on the content slide, some of you are probably wondering what that could possibly mean, because when we think of infrastructure, we tend to think of physical infrastructure, like roads and bridges and things like that. But the equity capital markets, it's a huge network and structure, and it requires its own infrastructure to smoothly and efficiently operate. So we're going to talk about that today as well. With the equity capital markets infrastructure, you have infrastructure for issuance and trading, right? And we'll talk about the NGX specifically, because at the crux of it, the NGX is the heart of the equities capital markets. It is really the heart and soul of where everything happens. So the Nigerian exchange, now known as the NGX, and we'll talk about that, it provides essentially the trading floor for securities of companies that are quoted. So what is it for a company to be quoted? You convert, you're a private company, you convert to being a public company, so from LTD to PLC. You offer your shares to the public and you list on the NGX. So I'm sure many of you are very familiar with either seeing it in the newspaper or in the corner of some of the news channels, or even online, where you see the share prices, daily stock being quoted. So that's what it means when you say a company is quoted on the NGX, right? Now, those public companies that are listed and quoted on the NGX are regulated. Remember, we talked about the NGX being an SRO, that is a self-regulatory organization. What it means is that if you participate in it, then you are bound by its own rules and regulation, right? And the NGX has an NGX Regulation Limited, which in the market we now tend to call RegCo. And I'll talk about that again later. But you have to comply with those. Now, primarily, the NGX is an equities market. Like I said, it's the heart and soul of the equities capital markets in Nigeria. But interestingly enough, and not many people know this, you can also list debt securities and derivative products on the NGX as well. Not our focus for today, but worth bearing in mind. So the NGX plays the most prominent role, like I've said, and very importantly, regulates speculative and insider trading in the ECN. So it is not just a platform for trading public companies, it is also a regulator of the manner in which those public companies are traded. Okay? So the NGX, aside from bringing companies to the market and listing them, also has post-listing requirements. The idea being that if me as a member of the public, if I take my hard-earned money and invest it in a public company that is listed on the NGX, there needs to be some investor comfort that if it is on the NGX platform, then the NGX is ensuring that there is some safe and ethical and proper trading, right? And because of that, the NGX has all of these rules and a number of post-listing requirements for these companies. And we'll talk about them, as we go on. Now, I've said several times in today's session, we'll talk about NGX, we'll talk about NGX, we'll talk about NGX. So let's talk about NGX. Many of you may even be confused by me using the term NGX, because what we would all have been familiar with for as long as we can remember is the NSE, Nigerian Stock Exchange, right? Now, the Nigerian Stock Exchange has now been demutualized. Pre-demutualization, what we had was that the exchange and regulation of the listed companies and everything to do with it was all vested in one entity, operation, regulation, etc., all in one entity. And that entity was known as the Nigerian Stock Exchange. And the stockbrokers and everybody, they were all members of this one entity, right? It was a company limited by guarantee, and it could not carry out business for the purpose of making profits. And in case anybody's wondering, it's because this same entity was regulating listing companies and operating the exchange. And so there was I'll give you the perfect example. SEC, the Securities and Exchange Commission, because of its regulation of the capital markets, it's not carrying on any business for making profits, right? And that was one of the things with the NSE at the time. Because a huge part of its function was regulation, it could not, do that. Now the NSE has been demutualized, right? And that means a number of things. The first thing to understand is that the entities have been converted from a limited company by guarantee to public limited companies. And we now have a group structure, right? We have the Nigerian Exchange Group PLC, which is itself listed on the exchange, but that's the group company. The subsidiaries within that company are the entity that operates the exchange, NGX, the entity that regulates companies that are listed and traded on the exchange, NGX Regulation Limited. And if you are active in the market, you may sometimes hear this referred to as RegCo, right? Then you also have an entity that holds the group property, which is referred to as NGX Real Estate Limited. Okay, this is the new structure. So for those of you who are familiar with the NSE, or for those of you who have heard about NGX and don't really understand what it is, how it differs, I hope that I've been able to clarify that. If you have a question around this in particular, please drop it in the Q&A box and we'll take it during that time. Now, the NGX listing boards, and just to be clear, the operation of the exchange hasn't changed. All that has changed is the structure, right, of the exchange. So we have certain listing boards on the exchange. There is the premium board. And before I explain each of them, when we say boards, right, this is where those companies that have made an offer to the public are actually listed, okay? And they have different compliance rules and ongoing obligations, but they also have different standards to be met before they can be listed on certain boards. So the first board is the premium board, right? And like the name suggests, this is premium. This is where you find the elite blue chip companies, right? They meet the most stringent, highest level of lifting standards, both by corporate governance and ongoing compliance. And as I mentioned, you really have to be the cream of Nigerian corporate world to get on the premium board. We then have the main board. The main board is really open to any company that is well established. It has a good track record, but for whatever reason, which could be technical, could be not serious, it doesn't quite yet meet the premium board listing requirements. Okay. We then have something called the SM, but we tend to just call it the alternative board. That's what you hear in the market. It's the alternative securities market. And what this does is that it's essentially a segment for small and medium-sized fast growth companies, right? Now, you might be wondering, we already have the premium board and the main board. Why do we need the alternative board as well? Well, one thing to bear in mind is that sometimes a company can be established, can start business, and it can be doing very well, but it's doing very well within its size and, within its sector and in its space. Now, does it have all of the requirements to meet the main board? Not even talk of the premium board? Probably not. But does that mean it should be excluded from access to capital? Certainly not. And so remember that in the primary markets, the access to capital is direct for the company, right? So the NGX some time ago introduced this alternative market board. And this is not something that is unique to the Nigerian equities capital markets. If you look globally as well, you often find that there's an alternative board. They have one in the UK, they have them in the States, etc. And it just allows smaller and medium-sized companies to essentially access that capital as well for further growth. Now, the last board that's listed here might sound a bit confusing given what I've said about the alternative board, and that's the growth board. And the growth board is the one most recently introduced, right? But this board is actually to encourage listing for startups and SMEs. You guys would have seen in the market, in the Nigerian economy, that we have a lot of companies that today they sound like startups, and by next week you're hearing they have a valuation of so many billions, particularly in areas like the tech space, right? And the idea is there's no reason why a startup that within 2 years of coming on board is doing very well, strong numbers, good customer base, great corporate governance, should not be allowed to list simply because it cannot meet a number of technical requirements of the other boards. So in order to access that capital, and also importantly, give the public an opportunity to invest early in those companies, the NGX introduced what we now know to be the growth board. In terms of infrastructure as well, so we've talked about the NGX, there is also the NASD OTC Securities Exchange. Remember, we talked about OTC just being person to person. Now, this is also a self-regulatory organization. And what it does rather is it provides a trading floor for equity securities of public, unlisted, I'll say it again, unlisted companies. Because remember, you can be a public company without being listed. Just because you're public does not mean you don't want to be listed, right? Sorry, just because you're public does not mean you have to be listed. And sometimes public companies, you get investors who want to trade their shares in them. But again, do they really want to start looking, okay, I have shares in this public company and I want to liquidate that investment. How do I find someone to buy? It's a public company, so there are no restrictions on who can become a shareholder. But how do I find someone to buy? That's what this infrastructure provides, right? I will say, though, that even though these are not listed companies, any securities that will be listed on the NASD have to be approved and registered by SEC first. But one of the advantages to using this is that it has less onerous, right? Easier, some would say, listing requirements. And so the process then becomes a little bit less stressful for the relevant companies. Now, settlement. what is settlement? Why do we need an infrastructure? Again, many of you will be familiar with CSCS. That is the Central Securities Clearing System, always referred to as CSCS, right? And what it is that it's a central securities depository. It essentially provides electronic clearing and settlement services, by which I mean, so we're talking about an equities capital markets, meaning a public market for the buying and selling of shares and stocks. But this is, modern times, and transactions move quickly. So if I want to buy them, does that mean my stockbroker, I'll transfer the money to him, then he'll transfer to somebody else, then that one will give share certificates to my stockbroker, then my stockbroker will deliver share certificates to me? No, that process is too long and it's inefficient for business. So instead, what we have in the capital markets for equities is what we call dematerialized form, which is to say that they're not bearer shares that are evidenced by your share certificates in your hand, right? I mean, you can get those if you really want them, but essentially they are dematerialized and they're in electronic form. So if you're an investor in the equities capital markets, you will need to have a CSCS account, right? And that's where your trading in stocks and shares and equities essentially happens. So that's where payments happens, that's where settlement happens, etc. And it's an integral part of the equity capital markets infrastructure because this is what we use for settlement. So we've gone through the infrastructure, right? Now, some of you may be wondering, but if we're talking about all these public issuances, public companies, public equity, how come we always hear talk about private placement? What's a private placement? Isn't that equity capital markets as well? You are 100% correct. It is equity capital markets, but it is what we refer to as a private equity issuance, right? So, and I'll take you through the difference very quickly. With a public issuance, it's highly regulated. It's subject to SEC scrutiny and listing rules of the exchange. However, you get access to a larger pool of funds because with a public issuance, it is very, very literally open to the entire public. Anybody in Nigeria can buy shares, even some international investors in certain instances as well. So the likelihood of raising the capital and even more with some very healthy companies, some very good issuers, very often their public offers are oversubscribed. Okay, so that's a real advantage to public issuance. That said, we mentioned that it's highly regulated, it's subject to SEC scrutiny and the exchange's rules, which means that it has a longer timeline. But of course, the other advantage is you have a liquid market. And what do we mean by liquid market? It means at any point in time, you can sell your shares. You don't need to be able to find someone who wants to trade. If you need cash and you're holding on to those shares, all you need to do is instruct your stockbroker and they can be sold very quickly, right? That's, public issuance. Now, with a private placement, which is a private equity issuance, completely different. So these private placements are actually not generally subject to SEC approval, except where it's a public company that is doing them, right? But when you have a private company with a private placement equity issuance, they have very little to zero SEC scrutiny and lower regulatory hurdles because they're not doing it on the exchange. And so it's easier to manage and meet transaction timelines. Now, there is one rule, which is that you can't offer securities, equities to more than 50 investors in a private placement. Otherwise, it becomes a public placement, right? But what this is good for is that it's good for smaller transactions, lower costs, less administration, less regulatory oversight. So sometimes what will happen is that you will see that in a company, maybe an investor wants to come in as an anchor investor or a significant investor, and maybe they want to take 20, 25% of the company, right? An easy way for them to do it might be by way of a private placement. Or you get a situation where a company wants to raise some capital, a private company wants to raise some capital. So it wants to issue shares, wants to offer shares for sale, but it doesn't want to become a public company and it doesn't want to be listed, right? It can do a private placement. And in those instances, it's the issuing houses that will go out and look for those investors, which again, remember, must not exceed 50 in total, but that's still a fair few amount to raise capital by. The one disadvantage, though, with a private equity issuance is that it's not very liquid, because again, we're not talking about a listed company. So if and when you do want to liquidate that investment, meaning you want to sell your shares, you will then have to find a willing buyer and do the trade, yourself. And if we're talking about a private company, then your share valuation is as between the two of you, because there's no easy reference given that it is not a quoted company. Okay. Now, equity capital markets, public issuance. I've mentioned it several times, selling shares to the public. So what are the ways that we do this? There are two ways, essentially, both of which I hasten to stress are offers to the public. Okay. But you have, with an offer for subscription, it's a direct offer. And the offers for subscription are where you will see things like public offer, or you will see IPO. IPOs cause a lot of excitement in the market. And that is what is known as an initial public offering. And it's usually when a valuable company or a company that is doing very well in business, highly profitable, comes to offer its shares to the market. It's deemed by the public to be a great investment, right? It's the sort of thing that people buy shares and hold them in the family and pass down as inheritance to children and grandchildren. So, for example, there are many, many people in the Nigerian market that have inherited shares in First Bank from when their grandfather bought shares in the IPO, for example, right? So that's a direct offer to the public. And typically it's done by way of a prospectus that is delivered through the issuing house, like we talked about. It's available to any and every, like I mentioned, it's offered to the public. That will include retail investors, meaning you and I on the streets. It will include your HNI, high net worth investors, and it will also include qualified institutionals, right? So what do we mean by qualified institutionals? That will be your pension fund administrators, your insurance companies, etc. But they again have to be qualified and go through their own regulatory hurdles to be able to invest. But the reality is such investments are open to them, right? In this instance, the issuer will take all the benefits of a successful offer because they have issued their own shares. And so all of the profits that are made, all of the money that is made from that sale will go to the issuer. At the same time, though, they will bear all the risks and liabilities of an unsuccessful offer. Now, I'm going to pause to mention that if you are active in the Nigerian business space, if you have been keeping a close eye on the equity capital markets in Nigeria, you will note that the equities market has been depressed for some years now, right? We've had a few public offers. We've had a couple of IPOs, but we haven't really had one to excite the markets, right? And I say this if you compare it to the last time that there was a real, genuine boom in the Nigerian equities capital markets would have been around 2007, right? So I would say between 2006 to maybe early 2008, before there was a massive crash in 2009, that was a boom time. And people were making money hand over fist in the equities capital markets. We haven't seen such highs again, but there's a lot of talk about improvements in the economy and a slowdown in inflation leading to much more of that. And if that is the case, we will then expect to see a lot more activity. So we'll start to see more IPOs, more offers for subscription. Okay. The other method for public issuance is an offer for sale. And it's an interesting one because this is where the shares are sold to an issuing house who then markets them to the public, right? Now, the company is protected from the risks and liabilities because you have the issuing house doing that. But it means that they can't get the immediate financial rewards because they have to get them from the issuing house. Okay, so I think that kind of brings us to the end of the overview, right? Excuse me. We have about half an hour left before we get to Q&A. So we'll move on now to talking about legal documentation and some of the legal issues that arise. So legal documentation, you have the the primary document is known as the offer document, the main offer document, right? And this could either be a prospectus, where you're talking about an offer for subscription. So your public offer, your IPO, they will have a prospectus. Or it could be a rights circular, where we talk about a rights issue. And forgive me, I'm not sure that we mentioned a rights issue on. Okay, so actually I might update these slides to include a rights issue. But in summary, a rights issue is essentially where a company offers existing shareholders, right, the opportunity to buy additional shares in proportion to their shareholding. So it's essentially an offer for subscription that is only open to existing shareholders because they're exercising a right. And that's why it's called a rights issue. And in that instance, your main document will be a rights circular. Then in the case of private placement, your main offer document will be a placement memorandum. So that's prospectus, rights circular, or placement memorandum. Now, what is key is that these are all offer documents and they all serve the same purpose and function, which is to inform the potential investors about the offer, but also very importantly about the issuer. So think about it. You're not going to buy shares in a company that you know nothing about. You need some information. And so in these offer documents, the issuer will disclose information about its corporate structure, its management, its current shareholding at the time, and then it will have the commercial terms and conditions of the offer. So like pricing, for example. It will have a description of the issuer's business and the sector. There will be extracts of different reports and opinions. So for example, you will have reports from reporting accountants, you will have the opinion from solicitors, like I mentioned, the claims and litigation opinion. All of these will be extracted. You will have an extract from a letter of the chairman of the board of the issuer, all of this information, right? Very often as well, you will have a section known as risk factors. And that's because if you're offering your shares to the public, you have to tell them everything, meaning you tell them the good and the bad, because it's an investment. And every investment carries with it some level of risk. And so you have to be saying to them, these are the factors that pose a risk to the business, right? Now, in reality, it would be highly unusual for a company that is facing significant risk to go public. And so those risk factors tend to be what you would expect in the ordinary course of business in the Nigerian landscape. And that's what tends to be included in your offer documents. And so nothing that would scare the investors, because if there's something that is going to scare off investors, then arguably you should not be doing a public offer at all until you have fixed that issue. Now, something important, very important, please, to remember in preparing offer documents is that there is liability attached to these documents, right? So the principal officers of the issuer and anybody at the company, right, who was involved in preparing that prospectus, including the issuing house, are liable to pay compensation for any untrue statement or misstatement that is included. Now, what that means is that a company cannot just lie in a prospectus. So they can't lie about their financial health. They can't lie about their business. They can't lie about their revenue or their profits, or they can't lie about potential liabilities they have or litigation. If they do, the individual officers at both the issuer and the issuing house will be liable to pay compensation, right, for any losses or damages suffered because of those untrue statements or misstatements. So I remember back in the day when I first started this practice, there used to be something we would call verification. And you would then have junior members of a team go through the draft prospectus and they would highlight every statement, right, that was depicted as fact. And they would then have to go about a verification exercise. So they would have to find out, where did this statement come from, who made this statement, what is the basis of this statement, to ensure that no untrue statements or misstatements find their way into the offer documents. Now, talking about the liability, there's one thing I should mention. Now, this prospectus, the offer document or your rights circular or your placement memorandum is a legal document. And to be very frank with you, because I have to tell you the reality as legal practitioners, it is supposed to be drafted by the solicitors. However, the practice in the Nigerian market for a number of years now has been for the issuing houses to draft that document. To tell you the truth, I'm not sure how or why that practice came about. I think that in part it may be because the issuing houses could bear some liability for the statements in that document. But in any event, it should be drafted by solicitors. Now, in my practice, I've come across one or two issuing houses that appreciate that point and will ask the solicitors to draft. So we have drafted some of them, but by and large, the market practice continues to be that the issuing houses will draft and then we'll share with the solicitors to populate with extracts and to review. That just tends to be the way it's done in the Nigerian markets, for better or worse. So another legal document that is very important is what is called the vending agreement. And this is essentially the legal agreement between the issuer and issuing houses. Now, when you're in practice, especially if you are in-house counsel, in-house legal at an issuing house, you will also hear about a mandate letter. The mandate letter and the vending agreement are not necessarily the same thing, and they shouldn't be confused for each other, meaning that a mandate letter or a letter of appointment does not mean that you do not need a vending agreement. You absolutely still need a vending agreement. And what that vending agreement does is that it essentially lays out the contractual relationship between the issuer and issuing houses, right? So it sets out the responsibilities and the obligations of each party. Very often on Nigerian transactions, and not just Nigerian, actually, even global, you will have more than one issuing house. Sometimes if you have two, they're just joint issuing houses, and so they will have joint responsibilities and obligations. Sometimes you may be in a situation where there are 3 or 4 issuing houses. I'm on one such equities transaction where we have 4 issuing houses. And in that scenario, we have one lead issuing house and the other 3 are joint issuing houses. And they have different responsibilities and obligations. The vending agreement is where those are documented. And they're stated there as responsibilities of the lead issuing house, and then, responsibilities of the joint issuing houses, right? The issuer will also provide indemnities to the issuing houses. So remember how we already talked about the liability of issuing houses for your offer documents, right? Now, issuing houses, remember, are financial institutions. They are capital and profit driven, and they're not really here to bear the liability of anybody else. And so they almost always, I've never seen a transaction where they did not require an indemnity, meaning even though I am liable, if for whatever reason I have to pay compensation because of something that has gone wrong with the offer, you, issuer, will indemnify me. Because as far as they're concerned, they're just there for the business and the advisory, and any liabilities should be borne by the company, and rightfully so, because they're just advisors. The vending agreement will also set out the fees that are due to the issuing houses and a cost schedule of the offer. It's worth noting that SEC has a schedule of fees and costs for capital market transactions, and they kind of set out what the issuers can pay the advisors, including the solicitors. And I dare say it's not very much, but those fees can be negotiated depending on the transaction, the complexity, the nature of it, which role you are playing, etc. But it is important to be aware that SEC does have a schedule of fees. So another very important document will be the solicitor's opinion on claims and litigation. As I mentioned, if you are acting as the solicitor to the offer, then it is your role to undertake due diligence on the issuer And part of that due diligence will be a review of claims and litigation, both for and against the issuer. At the end of that due diligence on the claims and litigation, the solicitors to the offer are expected to provide a legal opinion, right? And that legal opinion essentially sets out, this is what we've reviewed, this is what we've seen, and this is the total quantity of, here it says contingent, or potential liability that we have reviewed. What that means is that if you have reviewed 10 cases where there are 7 against your issuer and 3 instituted by your issuer, you will have to take the total of that 7 and say, in your opinion, that their total litigation potential contingent liability is X amount, being the total. Now, why does this matter? Again, you're making an offer to the public, and the public have to be aware. So an extract of this opinion goes into your offer document, your prospectus, your rights circular, your placement memorandum, and most importantly, signed opinion goes to SEC as well. So SEC needs to see this opinion in order to approve the offer. So those were, in a nutshell, at a very high level, the legal documents that you can expect to work on. There will usually be a due diligence report as well. But I think that we're all familiar with what that involves. When you've done your due diligence on the company, then you put it in a report format. But that due diligence report is not disclosed to SEC, and it is not extracted into the offer document, except for the opinion on claims and litigation. Okay, so what are some of the legal issues that arise in equity capital market transactions? So pre-issuance and prior to listing, the primary thing will be to ask the question, this client of mine, this company that wants to issue equities to the public, are they a public company? Because the ISA mandates that you can only offer shares to the public, equities to the public for sale, if you are a public company. And so like I mentioned, 7, 8 times out of 10 on these transactions, the very first issue you have to deal with is converting your private company to a public company. And that needs to be done entirely in accordance with CAMA 2020. It has an entire process for that conversion set out there. The next legal issue will be corporate governance compliance, right? Now, let me explain what I mean here, because I think sometimes there can be a misperception that corporate governance means, is this a shady company or not? And actually, it's not that simple. Corporate governance is not black and white. So by which I mean, just because a company does not have best corporate governance does not mean that it is a shady company. Very often, private companies are started by 1 or 2 individuals, sometimes even just by family members, husband and a wife, brother and sister, uncle and nephew. And they just have their own way of doing things, right? And those are things as between them. So for example, you may have bank accounts that only one person is signatory to, right? That is not the best approach in terms of corporate governance. That is not best practice for corporate governance, that all the bank accounts only have one signatory. But in private companies, that is not unusual. Okay, so again, it doesn't mean that the company is shady or there's anything untoward going on, but these are the sorts of things that you will need to essentially bring them up to code with. Now, in some sectors, they already have codes for corporate governance, and SEC and actually the NGX has a code for corporate governance for public companies as well, right? And so in preparing for an issuance and a listing in equity capital markets, this is one of the biggest legal issues, is the issuer compliant from a corporate governance perspective? And the legal issue there will be sitting down and identifying what should they be doing from a corporate governance perspective. And then when you have that identified and mapped out, you can then say, okay, what are they doing and where are the gaps? And how do we get them, properly in the space for corporate governance so that they are really ready? Because remember, again, like I said, the NGX has a code And there are also listing requirements and listing rules, a lot of which revolve around corporate governance, right? So things like, I'll give you a very easy example that we don't often get with private companies, and that is having an independent director on the board. That is rare in private companies. But if you're going to be a public company that is listed and quoted on the NGX, then you need to have independent directors. So that is something that they need to start thinking about. Who do we appoint as our independent directors, right? That's just one example. There are several. And then even each board in the exchange will have various rules. And as we mentioned earlier, the premium board, which is really the elite board, that has the highest standards of corporate governance, So big legal issues. Are we a public company? How do we convert to a public company? And what is our corporate governance compliance status? And really, this will be probably the biggest legal issue that you will deal with, right? Then the next thing will be, you cannot offer securities for sale to the public if they have not been registered with the SEC. So you can't issue them for sale. They can't be transferred. You essentially can't do anything with them. They have to be, and this is not, so we're not talking about the issuance, and we're not talking about the offer. We're not talking about the listing. We're talking about your actual shares. So those shares have to be registered with SEC, right? It's not a cumbersome process at all, but they do have to register with SEC. And what we tend to do is fold that into all of the rest of the regulatory process with SEC, because you need SEC's prior approval to issue or circulate or distribute any kind of notice or circular to the public around your offer, right? You can't invite members of the public to subscribe for or purchase securities. You can't call attention to an offer. You can't issue an invitation, and you definitely cannot issue a prospectus without SEC's prior approval. So these are some of the things, that require SEC's prior approval. Okay, these are some of the legal issues that come up. So we've talked about 3 so far. 1 is, are you a public company? 2 is, what is your corporate governance status? Are you actually ready to list your equities in the capital markets and go public and be listed? And then the 3rd one is the registration and compliance with SEC. I think this, yeah. Oh, sorry, I think that was actually a duplicate. Yeah, and there are obviously penalties, right, for failing to undertake that registration approval process. And that is something that as solicitors, you should be pointing out, like from day one. If you get a transaction timeline with all the different actions required, and you do not see a line item there about registration of securities with SEC or SEC approval, then that's something to flag immediately, right? Okay. Now, the next legal issue to think about will be listing requirements. As I've already mentioned, we have different requirements for different boards, right, on the exchange, depending on what which board you want to list at. But generally, just generally speaking, there are a couple of key listing requirements to bear in mind. The first we've talked about, which is you have to be a public company, right? The second is the free float rule. Now, this is an important one because you need to flag it at the beginning of the transaction as a legal issue for something that the company should bear in mind. Now, what is the free float rule? What it says essentially is that at any point in time, you have to have at least 20% of the shares in a company available for the public to trade in, to buy and sell, right? Meaning you have to have 20% that are held by retail investors. Now, why is this relevant and why does this matter? Because very often when valuable or profitable companies go public, what you might see is that maybe the founders of the company will retain a very large percentage for themselves, maybe 40%, 45% even. Then you'll get maybe 1 or 2 anchor investors that are coming in, taking 20% here, 10% there, etc. What these listing rules are trying to prevent is a situation where you have a company that you say is listed, right, and available to the public invest in, But in reality, they're not able to do so because everybody there is an investor, like a long-term investor in the company. And so there are no shares available to buy. Because in which case, then why are you listed, right? What does this offer to the public if there is no percentage of your shares available to trade in? And so that's why they have that free float requirement, where even if you have anchor investors, even if you have existing investors, you have to have at least 20% available to the public. Another listing requirement that is very important is in the context of an initial public offer, right? An IPO. There is a minimum lock-in period of 12 months. Now, what that means is that for 12 months, the promoters and directors have to hold a minimum of 50% of their shares in the issuer. All right. Now, why? Why do they have to do that? Can't we just list our shares and do whatever we want with them? After all, this is how we can make money. Well, no, this is intended to prevent market abuse. By which we mean, think about a situation where a company has 4 founding shareholders and directors, right? And prior to the IPO, they hold 100% of the shares. But when they go to offer, they're diluted down to, say, 30%. Imagine what happens where for them, it is a cash out kind of thing. So they quickly just sell all their company, all their shares in the company and leave. And they've exited the company, meaning that the management and the shareholders and the structure and strategy and vision of the company that the public invested in is no longer what the public is holding, right, in their shares. And so the idea is that this is not going to be a quick money grab for you. It's also meant to prevent it's also meant to prevent people from selling what we would call duds. In Nigerian market, maybe we'll call it one chance, meaning it looks great and glittery, but the truth is there's no value in this company. These guys are going to sell it. They're going to sell all their own shares. They're going to cash out, and you are left with almost worthless stock. So that's what that lock-in is also trying to prevent as well. And then, there's also a registration of securities, which we've talked about with SEC. The other listing requirement that is important to think about is the minimum market capitalization, right? What does that mean? It means, well, what's the capitalization of the company? Because this, again, matters for their relevant level, right, in the exchange. Remember, we talked about the different boards. So, for example, if you want to join the elites of corporate Nigeria and you want to be on the premium board, then your company needs to be capitalized to the tune of at least 200 billion naira. That's not easy, especially in the Nigerian economy of today. And so you see that sort of different levels, as we would say, right? But again, it helps the investing public because they understand then the difference between putting their investments, using their funds to buy shares and securities on the premium company on the premium board and one that's on the growth board, right? Now, we've talked about pre-issuance and listing. We've talked about when you are listing. There are also post-listing, listing and post-listing legal issues. And a big one is insider dealing. Insider dealing is one of those cool legal issues that you might hear them talk about in movies. They'll say insider trading in books and things like that. The reality is it's not cool and it is actually a crime. So it's not just that it's prohibited, it is actually a crime, okay? You can actually go to prison for insider dealing. And what is it? What does it mean? It essentially means that if you know something about a listed public company, right, that could change its financial health or its profits, for example, or materially change its business, something that would affect it. If you have that kind of information, it may then motivate you to buy and sell shares or people close to you to make a profit based on the information you have. Now, that is seen as almost cheating the public because the public is not privy to the information that insiders have. And so they are not in a position to make the same sort of profit that an insider would. And so the law prohibits the insider from profiting on the information that it has. And this is a listing and post-listing ongoing requirement. But it's a legal issue that always has to be considered, and I'll tell you why. when we think of insiders, a layman may think an insider means people who work in the company. But actually, if you look at the rules, insiders extend far beyond that. So immediate family of an insider will fall within insider dealing. So it's not okay if you have the information, then you go and tell your sister's husband to buy shares on your behalf because you know the share price is going to go up, right? Or if you know that there's some catastrophe happening and you need to sell your shares, you then go and get somebody else to sell the shares. You can't do any of that, okay? And actually, in order to regulate and enforce that, the exchange actually requires listed companies to maintain an insider list. And that list will not just include the principal officers. Sometimes it can also include their lawyers, the solicitors, if you're doing business with them on, a daily basis. Now, post-listing, there are continuing compliance obligations, and the NGX rulebook is big and fat, and most of the rules are actually post-listing continuing compliance obligations. And that is why you'll hear many entities go, I would love to access the capital markets, but it is onerous to become a public listed company because the obligations are endless. And that is the truth. So there is a cost to having access to that market and that liquidity. And that is the compliance and the disclosure, right? So once you're listed, you have to, like we said, comply with the rules of the exchange. And aside from things like free float and insider dealing, there's so much more. I mentioned having independent directors. You need to post financials very regularly. There's a lot that goes into it. We couldn't possibly go through all of the rules now, but I would advise that if you have a client that is contemplating becoming a public listed company, the first thing that you should do is familiarize yourself with the ongoing compliance obligations. Because when you're advising your clients on participating in the equities capital markets, that's one of the things you want to say to them is, have you considered the heavy obligations that come with being a public listed company? Now, that is not to discourage your client. That is not to discourage any company. As we have seen, there are a lot of advantages to becoming a public listed company, but it is so that your client is fully advised and appraised of what they are getting into, right? And there are penalties for non-compliance, including in the most extreme case, delisting. So the NGX can actually remove a company. They can't change your public status, your public company, but they can delist you, meaning that your shares will no longer be traded on the exchange. They can remove you from that. And obviously, that is a major warning sign to investors and the public if you are delisted. And I should also mention, speaking about delisting, that these continuing compliance obligations, even post-listing, should you decide that you want to delist, so you want to remove yourself from the equities capital markets voluntarily, there are also rules by the NGX as to how you need to go about that delisting. So I think it's fair to say that one of the takeaways in terms of legal issues is that there are pre-listing, listing, and post-listing rules and obligations, and there's a continuing compliance that you have to be aware of from the legal perspective when advising on equity capital markets transactions. And that more or less brings us to, I think, it brings us to the end, really, of the presentation, right? And what I'm going to do now, I'm going to stop sharing so that I can access the Q&A, right? Vincent, is that okay? Can we move into the Q&A session now?
Yes. The questions are listed there. You can just go through them and answer. Thank you.
Okay, excellent. So, wow, there are a number of questions here. So I'll just, I apologies if I don't get to all the questions. I'm just going to pick them at random because there are quite a few, right? So one of the questions here, which I think is a good practical question from Uchechi Anyaneli, is, in practice, what real-life challenges are faced by a solicitor to the offer when unpalatable issues are unearthed, right? So considering that the feedback is meant for the attention of the issuing house. And I think that's a very good question, because this is something that does actually happen. And I will tell you openly, as somebody who's done this for a very long time, I have actually been involved in preparing companies for IPOs where various things have come out, right? And I'll speak about one in particular without necessarily disclosing any names. Where, for example, we're trying to prepare this company, and it turns out that one of the investors in the company is a PEP, right? A politician. And it's a politician that has been investigated for all kinds of things. And that company was trying to do a dual listing. So that is a listing both in Nigeria and in a foreign jurisdiction. But when that came out, obviously that is something that had to be addressed by all of the parties. So we had to have meetings where we sat down with the company, we sat down with the existing shareholders, we sat down with the issuing house, and we tried to see how we could work it out, right? Now, sometimes the issues are practical things that can be taken care of. So maybe the company has not done certain filings, right? Or maybe sometimes the company has said they have a particular contract that they don't have. Those are things that you may be able to fix, or there may be things that can be addressed by PR or communications, right? But it's for all the parties to really sit down and decide how you want to move forward. And I have to tell you that in certain extreme circumstances, the decision may be taken that the company should not go forward with its public offer because what has been discovered would be detrimental to the offer, and the investing public, it would be unpalatable, as you say. But it's something to always think about. And the reason I mention it is because one has to, in the process of the due diligence, in the process of looking at claims and litigation, issues need to be flagged, right? And they need to be flagged at a stage where it is still just the parties to the transaction, not at the stage where that information is going out to the public. Okay, let me try and take another question. Okay, so I see another one around the role of solicitors to the offer. Answers from Oluwaseun Malamo. And it says, can the solicitors to the offer be held to account for failure to observe through due diligence, which occasions financial loss to an investor? Does a solicitor to the offer owe fiduciary duty to the public, right? Okay, so the answer is no on the fiduciary duty, because apart from the solicitors, you also have reporting accountants. Remember that as solicitors, our role does not actually involve due diligence on financials, right? So we're not responsible for that, and we don't give an opinion on financials and financial statements. So that is not something that is actually, we're not going to bear any loss or be held accountable for that. Another question from John Osaro. When a private company converts to a PLC, at what point in the process is it required to register its securities with the SEC? Is it after completing the process with the CAC? That's a good practical question, John. Thank you. And the answer is yes. So you cannot register securities of a private company with SEC. SEC won't accept that because SEC only deals with public companies, right? So you must first, that conversion to a PLC is really the first step, absolutely the first step when you have a company or an issuer that is looking at participating in the equities capital markets. Okay, let me move around to look for another question. Okay. Chino Sonwanye says, is it at all times that issuance of shares via public offer determines ownership of a company? Is it possible to only issue shares or additional shares only for the purpose of raising additional funds to continue business? Okay, so that's an interesting one, right? So I guess your question is, when you are doing, if you want to undertake a public offer, do you have to offer 100% of the shares in the company, right? And the answer is no. And you will see that we talked about things like the lock-in period for certain existing shareholders, right? So what may happen is that you may have existing shareholders who already hold, 20, 30% of the company. Obviously, they will be diluted by the offer, but they may also acquire more shares in the offer as well. So sometimes it may be the case that it is not the entire share capital that is, made available, right? And when you say issue additional shares only for the purpose of raising additional funds to continue the business, I mean, typically that is what it is for. It is capital when a company needs access to capital, and then they do that, right? I see another question again related to this is 20% float to be listed. Is it 20% of all shares offered for sale listing or 20% of the entire share capital? So it's 20% of the entire share capital, right? So what it means is that if you say you're a public company that is listed, then the rule says that in order to comply with that, in order to qualify as that at any point in time, then you must have at least 20% of all of your shares available for free float, right? So a question here says, as regards a vending agreement and a mandate letter, not to be merged together or confused, would a vending agreement be needed when the SEC is not regulating, i.e. the transactions between identified private investors and the duties of the issuing house will be set out in the mandate letter? So not necessarily, right? On a private placement, often a mandate letter will be enough, but it depends on the issuing house and the issuer. They can privately agree to have a vending agreement if that's what they would prefer, or to have a mandate letter. It's a little bit up to them. It's just that when you are doing a public offer, you must have that vending agreement, right? What's the difference between a premium board and growth board, and how do you spot the difference as an investor? Okay, so I think if you're looking at the boards, like say you go and look at them after this session today, right? What you will see is that, like I mentioned, the premium board is really elite. So you will see companies that have been in existence for many, many years, companies that are very profitable and have a high revenue, a number of banks, for example, right? But if you look at the growth board, like I mentioned, that tends to be newer companies, and from startups to SMEs, etc. Now, if as an investor you want to spot the difference, really what you need to do is then go and look at the different requirements for the premium board and the growth board, and that will give you an idea. But the truth is, just looking at the names will even tell you already what the difference is, right? Do you need to be accredited by SEC to offer capital market legal services as a solicitor? The answer is yes. SEC calls it being a capital markets operator, and you have to be registered with SEC to do that. So when you start any of these capital markets transactions, including ECM transactions, right? At the beginning, every transaction party will have to provide evidence that they are registered as a capital markets operator. And the issuing houses will check with SEC. They'll deliver the names of the transaction advisors and parties to SEC. And if you have any pending issue with SEC, maybe you haven't paid your renewal fee for being a CMO or anything, it'll be flagged and you will not be permitted to go ahead with the transaction until that has been rectified. So the answer is yes, you need to be accredited. When a company that is a public company re-registers to become a private limited company, what happens to the shares of the existing shareholders, especially within the analogy that private companies can only have 50 shareholders? And I think that's a very good question. We didn't really talk about, the reversal of participating in the equity capital markets. And it's a very interesting one. I'm actually working on one such transaction now. So what tends to happen with that is that by the time a company that is a public listed company is going to re-register as a private company, it typically means that it has gotten to the point where there are one or two majority shareholders, right? So maybe they own 60%, or they've acquired, quite a significant stake over the years. And what tends to happen there is that majority shareholder will make an offer to the other shareholders to buy out their shares, right? Some of them will take it up, some will not. And the idea is to go below the 50 shareholder mark. And when that happens, it will then delist the company and re-register as a private company. But it is very rare that a company that has more than 50 shareholders, that is a public listed company, all of them will decide that they want to become a private company. I mean, like you say, you can't really do that, right? I'm trying to identify questions for areas that we have not we've not addressed. Okay. Are all banks operating banking services in Nigeria regarded as issuing houses, or is it meant to be public companies? No, so public companies are not issuing houses, but again, being an issuing house is also something that you have to be registered with SEC as, right? So many of the banks have their capital businesses. So I gave you those examples like United Capital and Stanbic IBTC Capital, Chapel Hill Denham. A lot of the investment banks will have that license to operate as an issuing house, but it is not automatic that if you are, it's not automatic that if you are a bank, that you are then automatically an issuing house. Okay. I'm just trying to find some other questions. Okay, so I see that there are actually a number of questions on the restructuring of the NGX, right? So maybe I need to take that again at a high level. I mean, to be honest, the demutualization or restructuring of the NGX is something that we could have an entire session on, but we have to touch on them because they are an integral part of the equity capital markets infrastructure. So I'll explain it again. Now, what we used to have was known as the Nigerian Stock Exchange, right? And that one entity operated the stock exchange. That's the exchange where public listed companies are listed and quoted, and on the floor, their shares are traded, right? And in addition to that, whilst it operated that infrastructure, it also regulated the companies that were listed, right? Now, imagine, let me put it this way. So the way that SEC regulates all of the companies and businesses in the capital market space, imagine if SEC was regulating that and SEC was also operating the platform, right? That's what we used to have before. And that demutualization, because essentially it meant that you had this mutuality of operations in one entity. Okay, so that demutualization, think of it as the easiest way to think about it is a separation of functions, right? And so it then allows you, for example, to have an entity that might be a profit-making business because it is operating the exchange and the framework, right? Separate to the entity that is regulating. Because you can imagine that there is a concern there if you have an entity that is operating the infrastructure that is also the same entity that is regulating. And one might say that there could be conflicts of interest, particularly where operation of the structure is being done for profit. Previously, the stock exchange was not being run for profits, right? Even though it had members. And you can imagine how that would hinder its growth and its ability to do certain things, and so it became demutualized. You now have the regulating entity, that is one separate corporate entity, one company, that's NGX Regulation Limited. Then you then have the exchange, which is now being run as a business, and that's NGX. It's the stock exchange, but it's what we call NGX. You have another entity as well that holds all of their real estates separately. And on top of all of these, you have a holding company, right? The NGX holding company. And that company is itself a PLC that is listed. So I hope this gives some clarification. When these days now, if you hear NGX or the exchange, it is simply talking about the entity that is the stock exchange, where shares are listed, quoted, and traded, And that is separate from RegCo, NGX Regulation Company, which is the entity that regulates the stock exchange. I hope, and the companies that are on it. So I hope that clarifies that, because there are really a number of questions around that as well. Let me see what else. I mean, I think I've answered a number of these questions because I think a lot of these questions are along the same lines. I think okay, so one question says, I would like to get clarification on the alternative option available for a public company to offer its shares to members of the public without being publicly listed. Okay, so I think what we need to understand is that a public company can offer its shares, but it can't make an offer to the public if it's not listed, right? Now, what it can do is that it can do a private placement. And in a sense, that is, to members of the public, just remembering that a private placement is limited to 50 subscribers. So it can offer up to 50 members of the public, right, to buy shares in itself. That's really the only way. You can't do a public offer if you're not listed. And by public offer, I mean saying to the whole world, any and every, please come and buy shares in me. Okay. There's also another question asking for clarification on the difference between the primary market and the secondary market. So I'll explain that again. The primary market is where you have issuances, which means the company itself is issuing shares. It's saying, come and buy shares in me, right? And when you buy those shares in an issuance, it's a fresh issuance, right? The money goes to the company. That's the primary market. The secondary market, like the name suggests, happens afterwards. So after there has been that new fresh issuance and the company has issued its shares, you then have different members of the public holding their shares. But there's still a market for those shares, because they're public listed, right? So what you then get is a secondary market, which it doesn't actually involve the company at all. All that it involves are the buyers and sellers, right? And the stockbrokers and the registrars. So, like I said, if you're holding UBA PLC, for example, UBA PLC does a public offer where they're issuing new shares. That's in the primary market. And I buy shares there and I become a shareholder in UBA PLC, right? After the public offer is over, maybe 2 years later, I'm like, these UBA shares, the price has really gone higher. If I sell now, I'll make a profit, yeah? But the offer is closed. There's a secondary market. And that's where I can say to my stockbroker, I have these shares in UBA PLC. I'd like to sell them. And when that sale happens, the shareholder selling is the one who gets the proceeds, who gets the funds, the payment from that sale. That's the secondary market. So think of primary market as the company and the public, and then secondary market as shareholders and prospective investors. Okay. What else? A lot of the questions are the same, so please forgive me if I haven't read out your question exactly as it is. I believe a lot of them have been answered. A lot of them are on the NGX. And I think I've explained that. A lot of them are also asking for the slides. Vincent, are we making the slides available?
Yes, we are.
Oh, excellent. Oh, there's one question here that says, does the role of the registrar do away with the need for a post-transfer of shares filing with the CAC? The answer is no. No. The registrar is really a way for the company to manage its record of shareholders, because it's a public company that can have, in some cases, hundreds of shareholders, right? But the CAC still requires filing, because that is the national registry that that acts as administrator for companies. Okay. I think that is it mainly. I think that is it. So I'm just trying to see. So there's one question here that says, what are the challenges encountered in the relationship between the investors and the solicitors to the offer? Now, I want to clarify this, because I had said earlier that with the solicitors to the offer, if you are a lawyer advising a solicitor to the offer, then you're essentially acting in the investor role. However, you'll recall that I mentioned that because the investors are the public, there are too many of them for them to appoint or hire their own lawyers or solicitors. So actually, there is no contact between the investors and the solicitors to the offer. It is in order, and these are part of, like the SEC rules, right? And the regulation of equity capital markets. The idea is that because you have so many members of the public, somebody needs to be looking out for the public's interest. So whilst you have lawyers that are acting for the company, who is serving the interests of the investing public? And that's the role of the solicitor to the offer. But they don't actually interact with the investors at all. Okay. Somebody asked that they want to know if SEC gets involved in any way with private placements, which limited companies may explore to raise capital. So if you're talking about a private company, then SEC doesn't get involved, all right? If a private company is doing a private placement, that's really its business. SEC is not involved with that. However, you recall that if you become a public company, you register your shares with SEC. And so when a public company is doing a private placement, SEC will get involved. Now, they don't get involved to the same extent as they would a public offer, right? But given that you're a public company doing a private placement, there is some level of SEC involvement, essentially, just ticking the box, right? So, I think that's really it in terms of the questions. Vincent, I don't know if there were any other questions, but most of the questions in the Q&A.
Well, that's about it. Thank you so much for your time. We're able to keep 500 plus people on the webinar for about 2 hours.
I really hope so. I really hope so.
If you have time to go through the comments, the summary has been that it's been educative, it's been insightful, and it's been enlightening. And we'd like to thank you so much on behalf of the MD, ICL, and the CMSA for taking our time to give us this insightful teaching. Thank you so much, Zelda. As always, never disappoint. Thank you.
Okay, thank you everyone for logging in. 502 of you. On behalf of CMSA, thank you very much. And we hope that it's been informative, and have a good rest of the day.
Thanks. To the participants on how to join the CMSA and the capital markets operator, we're taking that on day 4. Also, we'll share the slides after the training. Have a great day, everyone. Have a good day, brother. Thank you so much.